Back, everyone. Tom and I took a couple weeks off. We had spring break last week, but the Mortgage Athlete is back on, and we have a very special guest today, Quinton Harris with Bank of England. We've got a Fed meeting this afternoon. He's going to touch base on what he's been doing, what he feels is going to happen there, and we're going to get an update on the different movers and shakers in the market area for the real estate agents to understand what's going on, and for our loan officer friends that are out there that are listening in of what they should expect. I know everyone has an opinion. I heard it 2 weeks ago from Barry Habib that on the 14th of March that we were going to see lower interest rates. And when that CPI report came out, well, unfortunately, we did not see that. So even the best of the best have their opinions and don't always come true. So, but we're going to try to give you our best. And I have two of the best here in Jacksonville, Tom Reber and Quinton Harris. Quinton, welcome to the show.
Hey, glad to be here. Thanks for having me, gentlemen.
Yeah. Okay,
well, Quinton,
Tom.
we're glad to have you on the show and participating with us. It's been a long time wait to see if we could get on your radar. You are a multi-talented fella that has not only lead your division for Northeast Florida with Bank of England, developed massive amounts of production in the real estate space on point of sale lending, but now you've expanded out since COVID into other things, podcasts, become quite the talented person besides just shucking mortgages, for crying out loud. So glad to have you on the show.
Yeah, man. Glad to be here. Thank you guys for having me. It's an honor to be on here. I respect the both of you and what you're doing here. And, Tom, you and I have had a relationship a little bit longer than I have with Tracy here. And I always admire you from afar and the way you conduct yourself. So it's great to be on the show. Thank you guys for having me today.
Cool.
I appreciate it. And, one of the things we like to get across, and to do this every week is to keep our, like I said, our real estate referral partners. They always, they're talking mortgages sometimes in their meetings, which is a danger zone. Nothing more I cringe is when I see a agent talking about interest rates and so forth when on their Instagram or whatever it may be. So right. I want us to be there, hopefully some of their resource and some of the information that they may see. And we have the Fed meeting, as Quinton has mentioned, is 3:00 this afternoon. Quinton, what are some of the things, preliminary chatter, preliminary predictions from the so-called experts out there that we're going to see, and how's that going to obviously affect our business?
Yeah, first I'll go back to Barry's commentary on the 14th of CPI. I think we all got a really big curveball thrown there. And I think it just shows that, even the best can be wrong sometimes. But to his credit, I think that they may have moved the goalposts in how they measure things. And I know that's one of his terms he likes to use. A little unfair because, we're all using lagging data and consistent information. And when they go and change how they measure, and what I mean by that is changing the weighted averages of certain metrics that make up that data, that's going to skew things. And so I know that happened there. And that's unfortunate because I think had it stayed the same, he'd be spot on. But today, what we're expecting, 3:00, the news will be out by 2:30. The commentary will be at the podium by 3:00. I think all ears and all bets and all the mortgage bonds and 10-year notes are going to be hanging by a thread until that 3:00 commentary. And I think what we're looking for is this. We're looking for out of the 2:30 meeting, did we raise it a quarter? Did we pivot and, and rate and drop it, or did we just maintain? And I think there's a theology from a lot of people that, the bravado of the Federal Reserve to raise a quarter, it would look bad in two ways. Number one, it would send a potential shock to the financial system and amongst the banks right now that still are in a bad position with their notes that haven't sold everything back to the Federal Reserve. It's going to increase short-term interest rates again, which is what's putting all the pressure on those bonds. And then the second thing is you don't want to increase it and 2 weeks later have to come back and do a decrease. That looks pretty bad on your end. It looks like a clown show. So I think that there's an ideology that just stay in, pivoting, and see what happens at zero, meaning no increase and remaining where we currently are on the Fed funds rate would probably be the best thing to do. I will say that I think the Federal Reserve is backed into a corner here for many different reasons. I think for them to raise this goes to the 2 points I just made. Plus, at the same time, adding that additional pressure puts that pressure on the European Central Bank, which is also one of the areas that they're focused on. Because, if we break that system over there, that is going to have implications over here, such as what we did over here with SBV had implications over there. SVB had implications over there. So I just can't see it today getting a commentary other than We're going to remain the course. We're going to continue to watch unemployment numbers and see how those rise. We're prepared to be at 3 point. I think they said they're going 3.6 to 5%, and that they want to have a target rate of 2% on inflation, which is just not happening and probably isn't going to happen anytime soon. So I think that's what we're going to get. We're going to get, hey, we're prepared to take the means necessary, but we didn't feel like at the time it was appropriate to raise rates. So I could be wrong, but I don't think they'll raise them.
You
Wow,
mentioned
that's a great response.
yeah, high level response for sure.
Yeah.
When I watched Barry did a seminar at I think he did for a lot of different lenders, did it for Loan Depot, did a webinar. That was before the Silicon Valley Bank issues. Do you think, and if you do think it had an effect, how did it affect what the Feds may decide?
I definitely think, I've known Barry personally since 19, and Dan, and they've been really, really on the ball with this thing and what happened here. But it absolutely affected it in a couple different ways. So, and, if you take a look at Silicon Valley, or any bank for that nature, when we take a deposit, it's a liability. Our job is to take 90% of that deposit. It used to be 80%. Trump lowered it increase it to 90 during COVID to put more influx into the monetary system. We got to go find a way to make money on that 90 so that I can pay you on the 100 that you put in there. And there's got to be enough margin there for the bank to make money. And traditionally speaking, I want to find that in the form by lending out mortgages, maybe car loans, and then definitely SBA loans. Well, with all the money that's been in the system and all the trillions of dollars that was refinanced at 2.75 to 3.5, we're not real attractive at 6.5 out there for the mortgage lending process. So that kind of takes the bulk of where we would lend away. The SBA lending is not a big portion to begin with, but with all the PPP money in the system, that's not really needed. So you take away those two aspects. Now, where am I going to put my money? Well, I'm going to go put it in bonds. And I think the reality of this is, most of those bonds VB had were bought in 2020 and late 2021. And it was bought under the notion that the economy is fine. There's no recession. You got Janet Yellen saying everything's transitory. And the reality is, if you believed that and your investment strategy, curtailed that, you bought bonds. And what you did is you didn't buy bonds, you bought notes, you bought 10-year notes. And so when you bought those notes, they do devalue as, the 10-year goes up. And they're being devalued on the premise that the Federal Reserve was raising rates at such a rapid rate. So the way I think that has an impact on the system now is everyone looked at their banking system a little differently because of the run on the bank, which was infused by Twitter. That's completely what caused that. Had that run on the bank not happened, the Silicon Valley Bank would still be here today, and so would Signature Bank. Neither one of them would be deemed taken over by the FDIC. So I think that there was a lot of people that stood to make a lot of money on the short of that stock, and I think they infused that through Twitter, and I think deposits had a run on the bank. Now, where I think that that's changed the banking game is now people are going, okay, even if they don't have 250 grand in one account, they're evaluating, like, is my bank safe? And I also think they're evaluating, where should I keep my money? I think there's a flock to the big banks, the top five, if you may, and those top five are automatically labeled too big to fail. So because of that, they're having to limit their risk because so much money is coming in there and they can't lend like we just talked about. So they're no longer buying mortgage-backed securities. They're no longer buying those long-term bonds notes. So, and they're not paying us jack shit on the checking account that we're putting money in there on. So, you kind of have this like, hey, if you want to put your money, be safe with me, I'm not going to go try to risk that money. I'm not going to pay you anything on it. And then I also think when it comes to mortgage lending, when the Power Five get out, which is what's happened, Power Five get out, that puts some strain on the industry because now you don't have the big players. And when the big players are out, we start to see that spread that we talk about that would normally be there between the 10-year and the 30-year note. That should be a lot lower than what it is right now. And it's not because the Power Five are out and they're not buying. So now we have other people buying, but they're buying under a higher risk premise. So therefore our rates are a little spread wider than they should be right now. I think if we're looking at a 3.5 on the 10, we probably should be 5.875 today. There's no way we should be 6.5 or 6.25 or 6, whatever you're looking at.
So bring that down to the street level for us, though, Quinton. Really gumpify that.
So here's where I'm at on a street level. You saw a massive dip on the sell of all the bonds on Monday, and then a little dead cat bounce on Tuesday, and back down again on Wednesday and Thursday of the week. I think what happened was you had the ability to lock in some lower rates, and now we're having the market settle in. I think once we get the commentary today, it's going to be one of two things. The settling in is going to be complete, or there's going to be an absolute cliff. And, the cliff would be from if they lowered rates a quarter today. They lower rates a quarter today, we're all back in. That treasury is going to fall down below 3.2. We're going to be in the fives by the afternoon. and probably, riding that out. But that's going to require a quantitative easing. Now the Fed is already quantitative easing. The minute they bought back all those bonds at face value and infused all that money back into the financial system, that's the definition of quantitative easing. Sometimes we get that confused with lowering rates. Those two things don't necessarily go together. So they're already telling the public we're prepared to ease. And I also think that if you look at the short-term 90-day T-bill and the 1-year bond, what you're seeing is a massive increase in that market right now, thus furthering that inversion that we talk about. So taking it to the streets, I think your buyers, but starting by the end of this week, all the way through June, that's when they're going to get these 5 rates they've been looking with. And if they can couple that with your permanent buy down strategies and your 2-1 buy downs, they're going to have significant value for homes that they can take advantage of. And if they're the same buyers that have been sitting on the sidelines saying, we're just going to wait for rates to go down or maybe prices to change, well, you're not the only one that's felt that way. So now you're about to get 50% more competition to the market. And so your sellers may not be willing to actually cooperate with you at that 2%, because as the demand jumps into the market, what you're going to find is the sellers are going to absorb that affordability and that demand, and they're going to stop giving you this percentage for buy downs. They're going to start taking the highest price offer. So there could be some scarcity that comes from this as well. So, if you're a buyer or if you're an agent that's working with a buyer that's, kind of kicking the can around about the rates right now or fence hopping, you might want to get off that fence now, because it could become a dangerous proposition in about 2 weeks.
Well said, Quinton. I'm telling you, you're Quinton Habib Jr.
It's the nicest thing I've heard all day, Tom. Thank you.
Well, let me tell you something. I'm going to call it like I see it. I can tell you, Tracy's over there. He's feeding, I'm feeding, and this information is incredible. And to take it to a Fisher Price level, because where I sit, what you're telling me is music to my ears. We've coined the phrase, or the phrase has been coined out there: date the rate, marry the house. You've just accented that. And quite frankly, we're in a neutral to slightly buyer's market today. Buy now, think about the consequences later, because if you're in the right location, right spot, get the house now, because in 4 to 6 months, to your point, maybe sooner, we could be back to a seller's market again.
Yeah,
because
absolutely.
And it was proven out. I read an article this morning that said in February, purchases went up, or fundings of purchase loans went up 14% month over month, just because that little spike in rates down that we got in January that stimulated the market. It caught on like fire, and here we are today. We throttled back a little bit in the past couple of weeks from where my chair is, but I think to the person on the street, Tracy made a great point. How do we break this down for the layman out there? Date the rate, marry the house. Get after it today. Don't wait, because if you're going to wait, you're going to miss this window, and you're going to be in line on the good properties. And the affordability index is going to come steamrolling back. We're almost back to where we were, a year ago.
Yeah, and I think the way I would explain that to a buyer on the street there, just kind of listening to our commentary here is, let's say you're kicking the can around at about a $400,000 home, and you're like, I like it, but I like it better at 380. At today's current interest rate. I like it better at 350 at today's current interest rate. We recognize the conundrum there and what's happening. But if that rate comes down to 5.875 or 5.5 in such a quick momentum swing that could happen, that home may not be priced at 400 any longer. That home may be priced at 425. So now you've really made a mistake, because the difference between that 5.5 and today's, whatever the rate is, 6.25, you're not going to make that up. That is not going to behoove you. So take into what you can get now, because the price of the home is not coming down. It's just not going to come down. It's going to go up, and it's going to go up as rates come down, because it's going to be absorbed by the seller. So you're going to be on the outside looking in. And you talk to any real estate agent right now, they'll tell you if the home's below, I think 380 is what I'm seeing. We're multiple offers already.
Yeah.
It's priced right. It's got to be priced right.
It's already there. Right. It's already there. And there's so much pent up demand. I'm sure, inside both of your pipelines, and any loan officer that's listening to this, you've got a plethora of buyers ready to go. You don't have a short on pulling credit reports. Lord knows we got plenty of credit report bills lying around here. What we have is we have short on inventory. Yeah, there you go. Short on inventory and the ability to match that with the rate. It's going to be a fury when that happens. It's just going to be.
Yeah.
Where do you think is the sweet spot? Because what happens, it drops to say the stars line up and it drops to 5.5 quickly. Right. And then you're going to have those people, oh, well, I'm going to wait till it goes to 4.5 because my buddy's got a 3% interest rate.
Right.
Where do you
So
think truly is the sweet spot as far as mortgage lending? Again, just talking about the 30-year fixed
yeah.
mortgage. Where's that sweet spot rate that just, well, we'll just call it the sweet spot because I don't know other way to describe
Yeah,
it.
I keep telling people 5 is the new 3s. So I think
Yeah.
anything with a 5 handle on it, that's going to be the sweet spot. And I think the reason is like 5875 sounds so much better than 6 anything. And I think that a borrower that hears that now is just
Hmm.
beyond themselves going, we missed it last time, we got to jump on it this time. And I also think that there's still some strategies involved with the sellers, that you're going to be able to get that 5875 to maybe a 5.5, 5625 with those strategies that I think anything with a 5 handle on it, the buyer is going to feel like an absolute winner.
I agree. I
Uh,
agree.
I agree with that, Quentin. I think back in the day, I'm going to date myself a little bit, going back into the 90s and the lending in the 90s.
You dated yourself with the manila envelopes or folders. That was your dating.
Sorry, I'm old school, ground and pound guy. A lot of people can relate to that still, Tracy. Anyway, back in the 90s, our normal sweet spot, it was a race to 6%,
Right.
6.0 on the 30-year rate calculator. And that was a number where I was told back in those days, Quentin, that banks make money, investors make money, affordability index based on the current cost of living was in tune. And if they can get the scales of balance with our economy to get around
Mm-hmm.
the 6% number or less range, everybody wins. Economic waves settle down and smooth over because everybody can make their fair share on margin.
Right.
But I think our challenge today is, can wages catch up with the hyperinflation that we had for that short time? I don't know, but we still, there's plenty of money out there. The private sector stepped in, and now we're back to where we were.
Yeah, I think the difference between the 90s and right now, and the difference between '08 and right now, is that the nemesis of inflation wasn't an issue compared to what it is at the moment. And more importantly, we weren't upside down in the inversion chart, especially on the short term. I know we always look at the 210, but take a look at the 110 and take a look at the 90-day to the 10. I mean, the 90-day T-bill should not be yielding almost 5% APY. It should not be happening. So anytime you see, treasuries, whether they're, I'm going to pull them up now, whether it's a 90 or 1 year or a 2 year, those should not be as far differential from the 10-year as they are. They shouldn't be. I mean, and what that's telling you is that the market, the investors, anticipate more risk in the short term than they do in the long term. And so I do think we are in for a little bit of, I'm not using the word turmoil, but let's use a bumpy ride, between here and the rest of the year. And I think that's going to come in the form of what the Federal Reserve is going to have to do is get those short-term rates in line. And the only way to get those short-term rates in line is to lower interest rates. Because if they don't get them in line, they're going to continue to apply pressure on any investment tool that the bank has right now to take your deposits in and leverage those deposits to go find money. So I think that we're going to see further rate declines because the Fed is going to back up and punt here. It's inevitable. And I think that that's going to further amplify inflation, unfortunately, but I think that's what we're going to see.
Tracy, what you think about that?
Well,
You
the
stoned him,
thought
Quentin.
he ended it on the thought that I actually have, and my personal feeling. Most people know my political perspective, but I think there's also reality, and I don't think, as we started the discussion off with Habib not getting, well, the normal measurement sticks were not being used for the CPI report, which threw people off. And I also feel the measuring sticks for inflation we're not getting the whole truth. And behind it, I think, is this wave or this surge that hopefully can be controlled as far as inflation is concerned. Yet bring the rates down a little bit to find the sweet spot in the economy to eat that up. Yeah.
I would agree with that.
Yeah, if I'm an administration person right now, and it doesn't matter what side that I'm on, I would much rather endure inflation than have to deal with an economic crisis. And the economic crisis being a stock market debacle, a banking debacle that most of our generation hasn't seen, or even the debacle of having to raise taxes or shit can Social Security. So I think they're going to kick that inflation can down the road as much as they can. To your point, Tracy, maybe continue to move those goalposts to make the ratings not as inflated as they should reflect. And in the meantime, I think mortgage rates are going to be the beneficiary of that. And again, I think it's a short window for about 6 months, but I think that's what's going to happen.
Mm-hmm. Well, this is a very, very provocative, in tune information for the street to kind of get their teeth into, Quinton. And it's super, super cool that you can share the details. Very impressive. I want to kind of change gears. I want to kind of put a little sunshine on Quinton, what he's accomplished in this marketplace. He's established a phenomenal partnership with UNF over the years, has come into North Florida. I want to say, what, about 8 to 10 years ago, Quinton? What was when you initially gotten here?
So I got to Florida in 2004.
Wow. So you've been here a long time. So anyway, you've done a phenomenal job of doing a lot of great things in our community. So I definitely, we tip our cap to you for that.
Oh, man,
University of North Florida is our backbone with regards to higher education and learning. And you've done a phenomenal job supporting them, not only participating with them, going to sporting events, getting your family involved, but your sweat equity that you served on the boards is incredible. I want to make sure that's been recognized as well. I'm a big sweat equity type of guy, and for you to give your time up to UNF like that's a very noble cause.
Oh, man, I appreciate that. Thank you. I mean, we got a great gym in our backyard here with UNF, and of all the universities in the state of Florida, state universities, probably private too, UNF has the highest retention rate of students that graduate and stay home here in Jacksonville. So our thought process was giving back to the community to help, tenfold and make the community a better place by making the student experience better over there at UNF.
You've also done a great job with hiring some of the graduates out of there, which has been great.
Tom, I have a big question though. I mean, if we're going to talk about UNF, is Bank of England going to create the fund here so we can get a football team in there?
It's a great question. We get it all the time, Tracy. And, I sit on the foundation board and I sit on the athletic advisory committee. And the reality behind the ASUN in football is they want football in the ASUN. They being the ASUN wants it there. So you see a lot of new teams coming in that have established programs. The challenge between having an established program and creating a program is somewhere about between $50 and $70 million to get that funding going. And even then, it doesn't guarantee it's going to be profitable. So I do know the university is evaluating. I know what it's going to take to get that done. But, I mean, the reality is JU is a great example, right? They had a football team and they had to shut it down. And I think that's what UNF doesn't want to do. They don't want to start something.
I was over there at JU, though, not directly involved inside of JU. But after I'm trying to remember, the last winning coach there left.
Kerwin Bell.
Yes, thank Kerwin Bell. I saw, being on the officiating those games and so forth went down. But UNF, in my personal opinion, would become as big as Central Florida. With a football team. And my personal opinion, you're on the inside. So this is just my opinion as an outsider, is that the other sports have gotten in there and they don't want football to come in because it will take center stage. And the baseball, basketball, whatever it is over there will move to the side. And that's why that's the biggest battle, because I really think if we don't have Ed Waters is our college football team in town. Central Florida, they'd be playing downtown, would be their home field, in my opinion. They have, obviously the facility there, but I think the influx of students in there, and it would blow up like Central Florida and South Florida did.
So I'll tell you right now, I don't think anyone wants a football team more than Coach Driscoll. It's only going to help improve the recruiting experience across the board, because a lot of those players are multi-athlete players at that level. I think the other thing is, when you take a look at from a competition level, UCF has about 4 times, well, I should say close to 4 times the enrollment that UNF has. It's not even close. So our enrollment numbers need to get up to support a football program as well. And I know the university has a plan to get that done over the course of the next 3 to 5 years. I've seen the plan, but I don't anticipate seeing a football program in the next 3 to 5
It's
years.
a big mistake in my opinion.
Yeah,
Anyway.
I think that I just don't see it coming there. But I will say this, on the topic, they got a lot of wonderful teams and a lot of
Yeah.
wonderful student athletes that, in my opinion, are overlooked. They do a wonderful job. They lead their conference. They're number one in almost every sport they participate in. Not always basketball, but they're right up there. But
Yeah.
from the golf programming, heck, man, we got the number 2 golfer in the world out there at UNF. Most people don't know that.
Yeah.
We got some of the top tennis players in the country there at UNF. We have one of the top sand volleyball teams in the nation. I mean,
Wow.
that school is elated with talent, but you got to step on the university to notice that and go out there and take a look. And they probably need to do a better job promoting that as well. But we've got some hidden gems over there that are overlooked, maybe because they don't have a football program. Baseball team's pretty awesome as well.
The baseball team's fantastic.
Yeah.
Yep.
But Tracy, I'm going to throw the personal foul on you. The reason why you're not welcome back over to the referees, you call too many technicals and you throw too many personal fouls on people. So banish you back to the damn referee jail.
Yeah.
But you're spot on, Tracy. I think you're right on. And they've got a facility. I'm friends with Greg Coleman, who is basically the backbone of the Bob Pace track event that they hold at UNF.
Mm-hmm. Yeah.
The community involvement of UNF is grassroots like that. I mean, hosting that for basically the state of Florida for the Bob Hayes track event is amazing. Mm-hmm. Just such great leadership over there. The business school, to your point, Quinton. Quite frankly, you need to be the adjunct professor for Mortgage Banking 101. With all the information that you have, they have to go through you to get out to the street nowadays.
Oh man, we do it in a heartbeat. And don't forget, they also hold the NCAA semifinals here as well, which brings about $10 million to the city while it's here. So they've got the second best track, believe it or not, in the United States next to Oregon. And there's talks we may be holding the finals for the United States track.
I've heard that. And I've talked to Greg Coleman about that extensively. And he's just like, holy cow, the facility is unbelievable that they let us have access to. That's why the whole state of Florida comes. I mean, St. Thomas Aquinas and all the schools in between flock here for the Bob Hayes Invitational.
Yeah, it's really cool. They've got some great facilities over there. And, a lot of people also don't know, and maybe they're just not outwardly public about it, but the university received a generational donation of about, I want to say it's close to $80 million in land from the Davis and Hodges family. So that university just grew in size.
Yeah.
And they've got a bunch of land to do some phenomenal projects with that are coming down the pipe as well.
Well, it's again, I wanted to touch on the relationship you have with UNF and Bank of England has put the money where their mouth is on things. But more importantly, Quinton Harris's sweat equity participation. I'm a firm believer in that people who put sweat equity on the table always have a voice, and you've done that. So
thank you. I appreciate that.
I tip my cap to you on that. Tracy, we've had so far this podcast has been fantastic. Quinton has taken us to a whole nother level. We're not talking about serendipity of opportunities and, making sure you lock your loans, take good loan applications. Quinton's takes us to a whole nother level.
So man,
well, in our final couple minutes here, Quinton, you're saying we should float right now. Are you telling your people at Bank of England float for the next few hours? We may see something.
If it's not locked by now, it's not going to hurt to float. Traditionally speaking, I want it all locked up. Let's get it taken care of. I think there's two ways to look at when rates go up or rates go down. If rates go up, the glass half full of me goes, great. Now the current pipeline is not going to be back sold. But if rate, and we'll get to the closing table, if rates go down, you're calling everybody that's been waiting, but you're also fighting on retaining the current pipeline you have because everybody's calling from whether it's sales boomerangs they got or whatever it may be. So there's always fights that come with every victory there. But if it's not locked by now, it's not going to hurt to wait at this point. There will be market overreaction either way. We'll see it settle in by the end of the afternoon. I'll say this though, if you're a loan officer and if you're a real estate agent, I think the message to your customer has to be this. You have to be able to be ready to move quickly and methodically when we're ready to go. You can't kick this can down any further and go, oh, we're in the 5s. Let's see if we get in the 4s. That's going to be a drastic mistake, and you're going to miss out. And I think as a loan officer, you can try to educate. And then you got to decide, okay, this customer's not for me at this point because they just don't get it. And we've got to move on. One of the pieces of value that I would say is as those rates go back up, and they are going to go back up, that person that wanted to be in the 4s, that's when you're calling that customer and you're saying, hey, today we're at 6.5. And most loan officers aren't going to do that because they're like, well, they wouldn't work at 5.5. Why the hell am I going to call them at 6.5? And then we're going to call them again at 6.75. And we're going to call them at 7. We're going to call them as high as this damn thing goes, because we need to reset expectations in that household of what those rates are, so that they're going, damn, man, we really missed the boat at 5, whatever. So as those rates start to come back down at some point, and they'll level off. As you go off that 7 tip, like we saw before, and you're coming back down in those 6s, you're calling with a level of enthusiasm that now that maybe they'll appreciate, because they're not going to appreciate it right now. And so you just kind of have to align yourself with who you're going to work with and get as much in as you can over the next 6 months, versus maybe fighting that borrower that thinks they're going to be in the 4s without points.
I always live by the saying, 1 in the hand is better than 2 in the bush.
Oh, yeah, absolutely.
Yeah. I would totally agree with that. And the only thing I really have to add to that, Quinton, is move at the speed of business. And right now, if you're going to look and move at the speed of business, when the opportunity happens, jump on it, make it happen. Shelter cost is shelter cost. Whether you do it now or do it later, your shelter cost is what it is. And when the opportunity arises in a year or so, when we can refinance you out of it, to your point, we can bring you back down to earth a little bit and we pick up some traction. But you gotta jump on that house now to have that opportunity to refinance later, or you're going to be chasing unicorns and you never catch them.
Well, and both of you have been in the game long enough. You're advisors, you know what to look at. And I think that there's a lot of products that are overlooked from the standpoint of, right now, a lot of people don't look at these 15-year FHA mortgages where your premiums are hardly anything now, which bring the payment down and you're getting a good rate. And a lot of loan officers go, oh, no one's going to do a 15-year. Well, it's like, well, not with that attitude, they're not. So like looking at some of these aspects that are out there and really challenging the thought process of maybe some borrowers that are locked into certain products that they just were accustomed to seeing. I think you just at this point have to advise and explore every option, because you never know what's going to fit someone's model at this time versus what we were going through in 2020 and 2020. 2020 and 2020 are the biggest disadvantage to our industry that I've ever seen. It took pit bulls and turned them into puppies. And and that's what sucks, because
pit bulls to puppies.
Yes.
We had dogs in this industry, and now we got puppies, man. And a lot of these puppies got spoiled. And the reality is that's exactly what happened. A lot of managers got spoiled. A lot of people got spoiled. But the reality is having to re-engage back into 2018 and 19 mode hasn't been the easiest for everyone. And if 2022 didn't do it, I think 2023 might not help you either, because we're gonna get back into that lull, and you're gonna get a little more help, and you're gonna go back into that puppy mode. And so you just need to be prepared that, listen, it's not going to be the old, hey, how can I help you? Do you want a 1 or do you want a number 2 or number 3? It's going to take some advising, some selling, and some creativity, and advising more importantly.
Well, that's spot on. That, my phrase for that is simply, if you're not providing collaborative selling approach today and providing total cost benefit analysis to your customers, you're not selling.
That's right.
This market's no longer for takers. It's for makers. You have to make your market. You have to sell your market, provide influence and value, which is the fundamentals of hand-to-hand combat mortgage sales.
That's correct.
And it's what you do. And this is why we're survivors. The law of the jungle is in full effect. The strong will thrive. The weak will walk.
Yeah.
And find other opportunities out there. But Tracy, man, this has been a powerful podcast. Awesome job today, guys.
Thank you, guys. And we'll finish up here. Anybody who has any last words?
Hey, I just want to say thanks for having me on the show. Greatly appreciated. And Tracy, if I could, I'd love to say plug our podcast if I could do that, if that's okay with you.
Yeah. Go for it.
If you're a loan officer, real estate professional, or just a general consumer, and you want to hear more about the local Jacksonville market, check us out at What's Your One More. That's with the number 1 on all platforms: Apple, Spotify, Amazon, Google, and YouTube. Our social handles on every channel are at What's Your One More. We'd love for you to take a chance to listen to us, and we do financial breakdowns and have all kinds of guests that have nothing to do with the financial markets, more on personal growth and leadership. And the episode we just dropped right now is with John Gordon, so check it out, episode 42.
Quinton, what days do you normally you got regular posting days for on Apple on the podcast platforms? What's your regular?
Yeah, we drop every Monday and Wednesday on
Monday
Apple
and Wednesdays.
Podcast and every platform. Yeah.
Okay.
So
I do
Spotify.
mine Tuesdays and Thursdays. So perfect.
Okay.
Listen to you. They got a podcast every day of the week, and they're off on Friday. Bam.
I love it.
Well, great show, guys. Quinton, rockstar status. Tracy, phenomenal job. Glad to be a part of the show. And then again, mortgage athletes rule, man. This is what we do.
Guys,
all right,
thanks
guys.
for having me on
I'm
the
going to
show
sign
today.
us
I
out.
appreciate it. You have a great
Cheers.
day.
All right.
Thank you.
Cheers.
All
See
right,
you guys.
Bye-bye.